Awesome. Sam, thank you so much for joining us. So I guess just to get started, do you think you could give us a 30-second intro of who you are and what you do today?
Yeah, so I'm a real estate investor entrepreneur. I took the path of a normal person, school, college, job, and kind of veered from that a few years ago. Went full time into real estate, and now I have $40 million worth of rentals. I own a house buying company that flips 300 houses a year, and then I also have an education brand.
Nice. Okay.
That was less than 30 seconds.
Less than 30 seconds, but that's good because the number of questions we have today is more than I'm used to. So we'll try to squeeze it all.
I love it.
So could you tell us like way before, all the way back into high school, what you did and kind of how that hustle or grind set came up for you?
Yeah, so I didn't really have a entrepreneurial upbringing. My dad was an engineer, pretty conservative, frugal guy. My mom was a teacher, but I grew up playing sports and interacting with friends a lot, and having that competitiveness of trying to win all the time at whatever I was doing, and took that over to the schoolwork and did, graduated high school with a 4.0. So school and, sports and everything were pretty easy for me just because I always wanted to win and be the best, transferred that to college and started doing a little bit of entrepreneurial stuff there with my buddy Lucas. We had a painting business where, we painted exteriors of houses. We actually tried to be bookies for a little while. So we tried a few different things and kind of got that little, I would say, entrepreneurial itch going, but then graduated college and went into the full-time job, and that really wasn't scratching, the itch of, the competitiveness or the entrepreneurial thing. So I started investing in real estate on the side. So that's kind of, I think where it all kind of started was more of that, trying to get that competitive itch going that you don't always get at your job when, you have an income or a ceiling that you hit. And then also trying to, the idea of being your own boss is always cool. So I think those two kind of things started my side hustle of real estate.
Gotcha. So, what'd you major in college? Did it have anything to even do with business? And what was your out of college job?
Yeah, so it did. It was a marketing degree. I actually have a master's degree. I graduated college or I was going to graduate in 2010 when obviously everything was in the crapper as far as the economy goes. So I stayed another year to get my master's, so an accelerated program where I got it after 5 years. So I did that, but it was a marketing degree with emphasis. So it was a business/marketing degree. So it helped me get a good job, and I feel like I've maybe used the presentation skills or just the problem-solving business analytical skills, but the actual degree hasn't helped me a ton. And then when I graduated school, I got a sales job selling Caterpillar construction equipment. Then worked my way up to be a sales manager there before I quit. So just just like everything else, just was trying to get better every single day. And once you earn a job, there's ceilings that you hit, that either income or whatever, or it be just how much you're utilizing your skills. There's ceilings at jobs. So that's why I went on my own.
Yeah, once I saw a couple of your TikToks talking about quitting a 250K a year job, I was like, this has to be sales. There's no way it's not.
Yes, yep, it was sales, and sales manager too, which was even better. I had about 150 grand base, and then I got paid off my sales guys what they were doing. So it was a good job, but wasn't doing it for me at the time as far as what I was looking to do.
Gotcha. So, did you quit right when you got started? Before you got started, I'm sure you had a few properties and then quit.
Yeah, no, I was strategic about it. I'm not one of those guys that says just quit, jump in, you'll figure it out later. I had been investing for about 3 or 4 years on the side, had probably 20 rentals built up and done some few flips and some wholesale. So I had a basis of knowledge and experience in properties before I made the jump. And it took me a couple of years, about a year and a half to, the first year I didn't make as much money as I was making because we were trying to get everything off the ground. But yeah, I think it's best to start as a side hustle. You're more bankable and you're more approachable from banks and lenders if you have a job. So I always suggest people starting off as a side hustle and then making the jump when the time is right.
So, your first property was at 2012, or when did you?
The first property was a 2014, 2015 timeframe. We bought it and put it on the market in 2015. So about 7 years ago is when actual got started with the graduated college, like I said, in 2011, and then just didn't do real estate at first for a few years. Just was doing the job and working with just being a big boy job and being married and all that growed up stuff. And then about 2013, 14 started talking about it, and then did it in 2014 and 15, and then kind of just ramped up from there.
So, was your first rental? You want to dive into the numbers? Was it a flip? it sounds like.
Actually, no, I bought it. I bought it to flip it and sell it, but because I didn't know about the BRRRR method or the refinance, I actually, I thought you had to put 20% down on every single rental you bought. That's just how it was. I knew you could borrow money to flip a house. I'd seen, HGTV and those type of shows where you borrow money from somebody who's rich and you use their money and then you split the profits with them. So I knew about that. So that was my goal, was to buy a house, flip it, split the profits with a private lender, and then take those profits that were mine and put them down on a property. That was my goal. So for every one rental, which is always the goal, I was going to have to buy two properties. But during the rehab, I discovered the refinance method, and I can show you the numbers and show you how it worked out or tell you the numbers. So you bought the house for round numbers about 75 grand. Put about 20 grand into it, a lot of sweat equity. So I had 95 grand in the property, and I was planning on selling it for 120, 130 grand. But before I did that, I found out about the refinance, and I took it to a small local bank, and they, gave me a loan for 80% of the appraised value, and it appraised for 125 grand. So they gave me a loan for 100 grand, which I paid off my private lender their 95 grand plus 5 grand in interest. And, now I have a $100,000 mortgage on the property, but I was renting it. So the rent paid the mortgage. So it's just kind of a way to back into putting 20% down, because banks don't care about 20% down cash. They just want 20% down equity because they don't want to ever own the property. So you can give them equity via cash, or you give them equity via buying at discounts and rehabbing. And that's the route that I went.
Gotcha. So for your first property, ballsy to do that, the first one to have it as essentially a BRRRR. But the private money, how did you convince this person? Were they like closely related to you as your first private money lender, as going as a guy, hi, I have no experience, but I believe I know what I'm doing. Can you trust me with this?
Yeah, it was a relationship I'd been developing for a while. I knew this gentleman. He was, I guess, kind of a family friend-ish. It wasn't anybody I was related to, somebody that, I'd been talking to, over the past several years, just about real estate and just my job and mentor-ish, kind of just somebody, an older gentleman that had done pretty well for himself. That, I say older. He was, I guess he's, in his 60s now, so he was in his early 60s when we kind of started this whole process with him. So, not crazy, old, but just old enough to have seen a lot of things and have a little bit extra money. And, we just were talking, and he was looking to diversify his money, and I told him what we were looking to do, and he said, if it's 100 grand or less, I'll, do a loan with you on it. And, he wanted to see the numbers and see the property, and he had a lien on the property in case something went wrong, and he was listed on the insurance policy in case it burned down. So he's very, very protected, and he's basically as protected as a savings account, and he's getting, a 12% return on it. So if you can frame it right and just make the right connections, eventually you'll find the right private lender. So that was kind of how that one worked. But there's obviously a ton of different options to fund deals.
I gotcha. Cool. Wow. So first guy, private money. Most of the time I hear people buying turnkey rentals and then dipping their toes, but you jumped right in. I like it. What does your portfolio look like today? If you want to break it down, single family homes, Airbnbs, all the different types of apartments.
Yeah, so right now we're sitting a little over 40 million in real estate, about 100 and it's probably bad, I don't know, but about 135 to 140 single family rentals. And then there's a similar about 130, 140 apartment complex stores split up between 6 apartments, and then 3 self-storage facilities. Then we got kind of dipping our toe into Airbnbs now. I never really did, not because I didn't believe in it, but just a capacity thing. I didn't want to do too many things poorly. I wanted to do a few things well. So kind of getting in the Airbnb game now, a little bit late, but still, the numbers are making sense. So we're looking at a house in Florida right now, and we have a couple of our apartments that are in some cool areas of town that we've taken a couple of the units and Airbnb'd them, as opposed to renting them on a short-term or on a long-term basis. So that's kind of how it breaks down a little bit, all in real estate, but just kind of a few different asset classes.
Gotcha. And have all of this, has it all been the BRRRR strategy?
Yeah, I mean, all 40 million of it's been with none of my own money. It's all been with the BRRRR strategy. The houses are in and out quickly with the BRRRRs, and the apartments and self-storage are a little bit longer play. Borrow money for the down payment, and then over 2 or 3 years, you create enough equity that you can refinance and pay back the lender plus interest. So it's the BRRRR method, just basically an extended BRRRR method.
So it seems like private money fuels this fire. How did you build up, not even just, I'm assuming it's a lot more than one person now. How did you build up, I guess, a huge, Rolodex of people that are willing to do these private money loans with you? What sort of terms do you give them? Like, oh, you'll get your money back in 6 months, 12 months, this interest rate, this total IRR.
Yeah, so it's kind of been a little combination of a lot of things. The one private lender we still work with today, and he's told his friends, and it's kind of one of those things where people always love to have the next investment or the next thing. He knew us, so he was proud of us, and he would talk to his friends about it. So we've gotten several lenders that way. We've gotten some just through our networking here locally. We deal with hard money a lot as well too. Private money is most of it, but I'd say 75% of it's been private money, 25% hard money. So we still use it, even though the rates are a little bit higher. It's just easy, and we got approved lines here. So it's just one of those things where it happens, not overnight. One private lender, and then a few months later, add another one in. Then a few months later, add another one, and then I've connected with a few through my social media network. Got a guy that's down in Florida that sold his software company for 50 million and didn't have any debt on it, so he's got some money to lend. So it's just one of those things that snowballs. Everybody sees the fact that we have X amount of real estate with X amount of private lenders use, and they think, oh, of course you do because of this or that. But it's one of those things where, like everybody else, it took me 6 months to convince Steve was the initial lender to do it, and then it took another 6 months to get somebody. It just builds over time. It's not an overnight thing or get rich quick scheme. It's something that takes time and effort and continual focus and persistence, and eventually anybody can get there, but it just takes time.
I get you. So 75% private money, that makes sense to me. It sounds like you give them either like a fixed 8% return for over 6 months or 12 month term.
Yeah, eight to 12% terms, depending on you asked that question. Yeah, so depending on the private lender and the deal, it's usually 8 to 12%. They'll finance 100% of purchase and rehab of the houses, and that's the majority of what we do. If we use hard money, like you're alluding to, then we'll usually use a line of credit or something for the rehab funds. We usually don't do those through the private lender or through the hard money lender.
Gotcha. So not actual, I guess it's a different type of hard money. So you're not sending an appraiser over there. You're not paying points on it. You just have a large line of credit. Like, is it a line of credit against all of your current equity within your entire portfolio? Is that how you get the line of credit, or is it a business line of credit?
Well, so the line of credits we use, it's on our paid off rentals, on our equity, and that's kind of through some banks. But the hard money lender, it is traditional. Yeah, they'll we'll tell them we're gonna buy this house for 200 grand and needs 50 grand worth of work. So yeah, they send out an appraiser and make sure that the property's good and underwrite it, and then they'll lend us the 200 grand, and then we have to pay them monthly interest until we pay them off with a refinance or a sale. So yeah, it's pretty traditional there. We just use our own funds for the rehab part of it, because it's kind of a pain usually to get a private lender to do construction disbursements or anything like that. So yeah, we the private lenders we use is traditional, the hard money lenders we use is traditional, just like anybody else would.
Okay. So yeah, but you just skip the draw period part. So you just have them do it for the purchase price. Just, I'm sure it's like 5 or 10% down at this point, and hold it at a 10 to 12% interest rate with the hard money loan.
Yeah, and it's nothing down. The point where we're at in the relationship we've developed now. They'll fund 100% of purchase. Especially if we're coming out of pocket on the rehab. They don't want to lend 100% of cost. And some of them do, most of them don't. But if it's like I said, if we're borrowing 200 grand from them and putting 50 grand of our own money into it, and it's worth 350, they're only lending 200,000 on a $350,000 house or $300,000 house. So they feel secure in that. Most hard money lenders will want to be in 75% of the actual property value after it's repaired, and that's all they'll want to lend. And some of them will lend 100% of purchase price and rehab, as long as there's enough equity. But a lot of them, like you said, will want some skin in the game, or at least a little bit of money down.
So when you're taking a look at these things, what sort of equity do you try to buy it at? Like a 50% of ARV?
We're like 70% of ARV minus repairs. So some depends on how much the property needs. I just want to be all in for 75% or less of the after repair value, including my purchase, my rehab, my holding costs, the closing costs, every single cost, the money cost, the interest I'm paying my lenders. All in, everything, 70% minus repairs is what we buy at. So it could be 50% of the appraised value, could be 30%. It just depends on how much it needs. So that's how we look at it, a deal by deal basis. And we've tightened that up a little bit. We were buying at 75% minus repairs when the market was going crazy, but it's still a strong market out there. So we're at 70% just to give us a little more leeway.
Gotcha. And I think you said 250 homes a year is what you're looking to flip, or? renovate?
Yeah, so we're gonna do about 300 this year. We call it our flipping business. Majority of those are wholesales. We're probably going to rehab about 75 houses this year and maybe wholesale 225. So we got about 300 going through the turnstiles, and majority of them we wholesale. We'll close on some, or we'll just assign or double close some, and then we will do our good share of rehabs as well.
So I'm guessing everything that you're wholesaling, it's just you would have, if you don't wholesale it, you just do the flip yourself. Is that kind of the business model?
Yeah, no, yeah, yeah, we are able to, and usually we'll put a non-contingent contract on it. So if we can't wholesale it, we'll close on it and then try and wholesale it, or we'll take it down ourselves and rehab it. So we're that's kind of one of our benefits is being able to offer firm, strong contracts and just figure it out after the fact as long as we're getting a good enough deal.
So are you doing everything in Missouri? Is it all local with you?
Yep, everything's here in the St. Louis metro area. Yep. I'm looking at some Airbnbs in Florida right now, but everything's here locally. Maybe branch out. Looked at a couple apartments, complexes outside of the St. Louis metro area in Illinois and Tennessee and a few places. But for now, there's so much potential here locally in St. Louis that's where we're sticking and that's where we know best.
Gotcha. Because I've been trying to play this game, but I'm in California, so all of my stuff is within the Midwest, and I'd say it's a little harder for me to do these flips just because it's like I don't get my eyes on anything really. It's just what so and so says, what it needs. How do you, I guess, manage even still doing 75 flips? I'm sure you have a team. How did you actually build out that team? Who was the first person, contractor, project manager? How'd that happen?
Yeah, so it's been a process of building out a team, like you said. We have a project manager and a project specialist. So somebody kind of managing the project and managing all our subcontractors, and then a project specialist who's a little more hands-on, maybe doing some of the work themselves or finishing up the project. So we started out with a project manager, basically just you know paying them out of the deal. So if we're using a private lender, we borrow 200 grand, 150 grand for the purchase and 45 grand for the rehab. Well, we'll borrow an extra 5 grand from the private lender so we can pay our project manager. So we paid them out of the deal, so it wasn't out of pocket. So we started out with that, and been doing it for, like I said, 7 years. So at that point, we've kind of grown to a decent sized team that manages it, and then we just have contractors that work mainly for us or solely for us and a little bit for other people, but we kind of have a core group that we go to that we know and trust and don't have to get three bids on everything at this point or anything like that. We just kind of know that they'll do a good, fair job and, offer us a fair price. And of course we, price check them every once in a while to keep them honest, but it works out pretty well.
How's the building costs that are constantly shifting? Has that made any issues or waves with contractors?
Yeah, I mean it has. So the supply's been pretty shoddy the past couple of years, and then obviously the prices have gone up, so that's cut into margins. But I mean, up until recently, the house prices were going up faster than the materials were. So it's just one of those things where it ebbs and flows. Like interest rates are higher now, but so is rent. So everybody's paying a little bit more for the money, but their income they're bringing in, if they're doing it right, should be substantially more as well. So kind of one of those things. There always seems to be a check and balance type of thing. Material prices were high. Labor was high, but the prices were going up in value like crazy. And now that that's kind of slowed down, rental rates are still kind of going through the roof. So things are just usually with real estate, there's enough different forks you can go down and different paths to make something work still.
Yeah, since I mean we have a shift in the market that's happening slowly as we're seeing it. Do you see the banks being a little bit more bearish on like ARVs of what they predict? Hey, I'm going to start a flip. It's going to be done 6 months from now. They have to take a guess at what that after repair value is for that hard money loan. Do you see them being a little bit more conservative and not loaning as much out?
Yeah, they are. They're being a little more conservative on that, and of course the interest rates are higher, which makes it harder to cash flow. But yeah, that's just one of the things. There's a little uncertainty in the market right now with how high are the Fed's going to raise the rates. That's obviously affecting the values of properties and demand. So it's a guessing game right now for a lot of people. So banks are just, having to play the same thing we're playing. So they want to err on the side of being a little more cautious. So that comes into play, but also there's a lot less people out there buying houses. A lot of people that have done it on the side aren't there. So it's easier to get deals now than it has been. And, with less competition, you can buy deeper. So again, it's not everything's ever perfect. It's hard to have the perfect storm we've had of houses increasing in value, interest rates being cheap. No matter what happens, you'll make money on a deal. That's not usually the case. So what we're going into now is just going to be a little bit more of obstacles and a little more things you got to maneuver to make deals work, but that's how real estate usually is. That's how it's been every year up until like 2020. So I remember 2016, 17, 18, it took 30 days to sell a house. Every flip took 30, 45 days to sell with a $5,000 price drop here or there, and is what it is. Now, if a house doesn't sell an opening weekend for what we're asking, people flip out, even though that's just, we're getting back to normalcy, I guess is what I'm saying. So yeah, it's not as easy as it has been, but it's still very, very, very manageable. People made money in real estate when the interest rates were 17%. So it's still manageable. It's just a little more challenging.
100%. Yeah, I don't see it as recession. Just sounds like we're leveling back out to normal. And like you said, significantly less competition. Do you find it a little bit easier to get a deal? Do you usually get your deal flow? Do you have people that are cold calling for you to be able to find those deals? Or do you have wholesalers that you buy them from yourself?
Yeah, a little bit of everything. So we got a marketing division. We spend a decent amount of money a month in marketing, but majority of our leads come from wholesalers and real estate agents. So yeah, we're out networking every day trying to find deals. We got 5 full-time buyers. Their job is to buy 50 houses a year each. So we have a team doing that. That's marketing as well as going out and networking to find deals. And I'd say they're probably a little bit easier to come by, especially in the multifamily game. We've noticed quite a few more deals coming our way. So I think it's just one of those things where, like we just talked about, it's harder to come by deals, or it's harder. Everything's a little bit harder. It's, with the raising interest rates and supply and demand and everything that's affecting it, it's just takes a little more maneuvering, and most people want something that's easy, and it's been easy recently. So the fact that it's getting a little bit harder, people are leaving, even though if they stuck around, it'd be easier. So just people are lazy and they want, to have it now and not have to put any effort into it. So if you're willing to stick it out, put effort into it, there'll be a lot of deals now and on the other side here soon.
I like that. Now I have so I went through all of your content, which took me a few hours, but just sporadic questions, so they probably don't really follow a nice flow. You say you use DSCR loans on essentially all of your properties. Why DSCR loans? And for people that don't know, it's debt service coverage ratio loans, so you're able to buy the property, but they usually aren't as good as keeping them in your own personal name. Is there a reason why you do that even for these single family houses?
Yeah, so you can buy, up to 10 rental properties in your personal name, with residential mortgages, 30-year fixed, which are ideal for cash flow and security. So we've done everything with the DSCR, the commercial loans with banks, and, that means that banks are going to lend you money based on, they look at your income at first, but after that, they don't really, and they don't ever really weigh it that heavily. It's based on the property and how good the property is. They base it on the deal. So if there's equity in the deal and you got a decent credit score and the deal cash flows, then they'll lend you money on it. And that's the only way we've been able to scale so quickly. I mean, I have $25 million in debt, like I say all the time, and I do all right for myself. I make pretty good income, but I don't have enough income to have that debt to income ratio for $25 million in debt. So it's really the only way to grow that quickly is to get into these DSCR loans and to get into commercial lending at small local banks. That's just the way to do it if you want to grow quickly. If you want to do it slowly with 30-year fixed mortgages, like you said, with that your DTI is going to come into play. They'll probably only give you a loan or two a year, especially unless you're making a lot of money, which most people aren't. So it's just a different strategy. It's a quicker growth strategy with not as good terms, but I look at it as a long-term relationship. And the relationships we've built with these small local banks that do these commercial loans and these DSCR loans are awesome. They do a lot of really cool things because they're small local banks, and they don't have to abide by the Fannie Freddie rules that you're going to have to get with those 30-year mortgages. So it's just a different strategy, and everybody has their own. A lot of people start out with the residential mortgages, like you're saying, and then move over to DSCR. We just started with DSCR at the beginning.
Makes sense. So you already knew you were going to go big, so you started it from the beginning. That's good. So you've said this a couple times, always using a small local bank. What sort of advantages have you seen yourself getting utilizing the small local bank versus not necessarily like a large scale institution, but more of like mortgage brokers? What have you seen that these small local banks are able to do for you that United Wholesale Mortgage can't do for you?
Yeah, so these small local banks can do whatever they want, literally almost whatever they want. So these bigger banks or medium-sized banks or even these like brokers, what they do is they are positioning and packaging each loan to sell off on the secondary market to Fannie Mae and Freddie Mac. So everything's got to be, certain guidelines and 6 months of this and holding costs and, reserves and all this stuff, which is fine for some people, but that's a pain in the ass and it's just extra work and, usually have to hold it longer. So that's fine. That's what they do. But with these small local banks, they don't sell to Fannie Mae or Freddie Mac. They hold the notes in house, meaning rather than packaging a loan and selling it and making $5,000, $10,000, they make a little bit every single month on the interest. They borrow money from the Fed fund at X amount and they upcharge it to you a little bit more. So the fact that they hold it in house and don't sell it means they can be flexible. They can give you 30-year terms. We've got 30-year mortgages from our small local banks. We've got 25-year mortgages. We've got fixed rates for 5 years. We've got fixed rate for 10 years. So they can kind of do whatever they want. And as you develop a relationship with them, they can be flexible. Like we've done 2 cash out refinances on a rental portfolio and pulled out $2.5 million of tax-free cash from the equity we had built. Like, big banks aren't going to do that. Many small local banks are just relational based, and they are investing in you and the community as well, and they want to see you succeed. So it's more of a relational business. These bigger banks and brokers are transactional. So for me, I'm always going to choose the side of relational businesses. Just relationships come in handy. So that's why we do that, and that's why we may pay a little more interest, but the relationship that we built and are building are more than worth a little bit more money every month out of pocket, in my opinion.
Gotcha. This is probably going to get a little more in the nitty gritty of what's your LLC structures, or how do you divide up your assets? Do you just have an overall umbrella insurance over everything? How do you really do that?
Yeah, so we have overall umbrella insurance over everything, and some general liability and things like that. But as far as the LLC breakup goes, all of our bigger assets have their own LLC. So apartments and self-storage facilities, we start an LLC just for that specific asset. But for our houses, about every 30 to 40 houses, we start a new LLC. It's a couple people we talked to did it. We don't start an LLC for every single family rental like you're technically supposed to. That's just not feasible. I mean, that's the way to really, really cover your ass. But does everybody drive, 2 miles an hour under the speed limit with 2 hands on the wheel, buckled with, bubbles around their face when they drive? Like, obviously, that's the way to do it, but that's not realistic for most people. So every 30 to 40 rental properties, we start a new LLC and then, put them all on one loan. So we'll buy 30 rentals in one LLC, all separate loans, and then we'll do a refinance and put them all in one loan, and then we'll start a new LLC. So that's kind of what we've done and probably going to continue to do, as we keep growing.
So you end up doing like blanket mortgages over the 30 to 40 houses and make it simple, so one big payment?
Yep. And usually pull out some cash out of the equity and then pay off a few rentals. Like we have a handful of paid off rentals that help with just security as far as, having paid off assets. That's a nice secure position to be in. But also then we take lines of credit against those paid off assets and lend them out to our other companies. So it's just kind of an extra little income source.
Is that also where the small local banks come into play, of they are going to let you lend out on a rental property even though it's like a HELOC on a rental property that's not technically your primary?
Yep, exactly.
Gotcha. Some of these have already been answered. Self-storage facilities. I've seen a lot of people talk about them. No one ever really dives into the numbers on them of like, how do you even know if it's a good deal of what you're getting? What are you looking for when you're looking for a self-storage facility? And, how'd you get into it?
Yeah, so we got into one of them is like, we bought a 12-unit apartment complex, and behind it, it had a little self-storage facility, like small one, like 15 units or something that, some of the tenants rented, but it usually was rented from other people. So it was like kind of dipping our toes in the water. And I like the idea of it. It makes sense that people buy extra stuff when the economy's good and throw it in there. And when the economy's bad, sometimes people have to downsize and store their stuff. So I think it's pretty well known as a pretty, solid, safe investment, not huge returns, but just a safe place to diversify. And so that has kind of been the case for us. So that one doesn't really count, 15 units. That's just, we kind of threw it on the loan with the apartment. But the other two that we bought, one of them was a 66 unit and the other one was a 66 unit as well. But also, we built a few more buildings and then did some boat and RV storage. So those are a little bit bigger, nothing crazy. But I guess both of those are like a year to year and a half in, and we're turning them and improving them. So I don't have like years of experience in it, but it's been good. We just kind of run the numbers like anything else. You know what you buy it for, your debt, there's not going to be much maintenance. And then everything's ran through software. We don't have like people on site. It's all done through software and then over the phone. And then, we know about what, each unit's going to rent for, and then extrapolate that out with vacancy and then your money costs. So it's one of those things where you're probably not going to cash flow as much if you have $1 million in self-storage. You're probably not going to cash flow as much as you would on $1 million apartment complex, but it's pretty consistent, safe income that very, very headache free. You're not have no one's living there. There's no toilets. We don't have any climate control. So it's just a door and a room or a parking spot. So it's been nice, and it's just I don't love it, honestly. It's something that I'm glad we kind of stumbled into the ones we bought. One was listed, a couple brokers brought us some, but we're not pursuing anymore. But never know, if something falls in our lap, we might buy it. But it's been interesting. I'm glad we have the few we have, but other than that, I'm good on it.
And I saw one of them you had owner financed, well, a good amount of it owner financed. How often do you get sellers financing, and do you usually do any special deals to encourage that?
Not really. I think that might come into play. Just money's been so damn cheap recently, now that it's getting a little bit more expensive, seller financing might come into play a little bit more, and I think it's good for people to have, in their tool belt. But this one, that was kind of what the seller wanted. We gave him some money down. So just for round math, these numbers aren't exactly right. They're close, but we bought it for $500,000. We gave $200,000 of private money to the seller. He didn't owe anything on it, so he got $200,000 cash. And then the $300,000 he financed over 15 years at like 1% or something like that. So it's just, we pay him whatever amount a month that comes off of the principal. And, it's just it's a good way for sellers to limit their tax liability. Because if he got $500,000 check, he'd obviously have to pay more taxes. So he get a little bit of check now, pay taxes on, and then slowly over 15 years, he gets some passive income coming in, but doesn't have to own it. So it's just something that it can be structured any way you want. It's got to be the right deal, the right situation. But it just kind of worked out with that one.
And in this scenario, the private lender, I'm assuming he's not getting his money, cash out refied in 6 to 12 months. Is he in it a little bit more for the long haul with you?
Yeah, so our apartments and self-storage, those are 2 to 4 year investments, and we till they get their money back, and that's the same with this one. It's about 1.5 years in, so another year or two will get them their money back. There'll be enough equity created in the deal that there's enough we can pull out and pay them back.
So do you usually buy these apartment complexes with a bridge loan, or do you do a 5-1 arm on most of them, and on year 5 or whenever the prepayment penalty goes away, you just refinance or sell?
Yeah, a little bit of both. So we've usually do a 5-year arm. We have one of our apartments is with agency debt with Freddie Mac, but same thing with the house. We'll buy it, and then there'll be an arm, and either before, when that arm's up, we'll have created enough equity that we can refinance and get a new loan with a new arm, but have enough equity created that we're able to pull out enough to pay back that private lender plus some kickers along, a kicker at the end. They get active income from the cash flow from the property, to kind of feed them, and then at the end they get their money back plus a little kicker to sweeten the deal.
Makes sense. So in one sentence question, this is probably going to be a paragraph response. What do you think about yourself that helped you scale so fast? What did you use and leverage, do you think, that really was the catalyst to scale as quickly as you did?
Yeah, I think a lot of it's just having the right mindset and the right people on board, just having the mindset to grow and always improve, but then having the right team and the right business partner to, help along the way and maybe fill in the gaps where I have blind spots or that my skills aren't as sharp. Having somebody else that has, the yin for your yang, I guess, for lack of a better word, somebody else that, can do the operations and finance stuff that is not as exciting or as I'm not as good at, and I can focus on what I'm good at. If you get in your genius zone and really focus on what you're good at and you enjoy doing, that's when you're going to see really massive growth. You're going to have fun doing it, and you're going to continue to push yourselves. When you're doing something you don't want to do or don't like to do, that's when it's pretty easy to put that off or not spend extra time doing that. But if you enjoy it and love it, and you do the things you like to do, and other people are doing things that they like to do, and combined it equals a business, then you're going to continue to push it and grow and put that extra hour a day or extra 5 hours on the weekend because you enjoy doing it. So that's kind of been it. I'm driven to buy a lot and do a lot and create impact, and it's just kind of all come together, and real estate's been a great way to channel that. And then obviously the market's been great the past 5-6 years has helped.
Yeah. So what are, I guess, all the ventures you're doing? So we have self-storage, we have apartment complexes, we have single-family homes, some Airbnbs. You're doing the wholesaling. I don't know if you're actually flipping them or more of renovating them and refinancing and keeping all of them. Is there any other businesses out there?
Just my education business, my the social media stuff and education business is one of them. We have a non-profit here in St. Louis that we started about a year and a half ago, and then those are kind of the main businesses now. I have a couple like e-com stores that I hired out. When the money coming in, when the market was kind of the stock market and all the markets and crypto and everything were kind of teetering. I bought some e-com stores that are self-managed. I don't manage them, like somebody else manages them for me. And then next year we're going to start an investment company where we're going to put a percentage of our profits into a company that's going to diversify into non-real estate related assets, like buying lawn care business or investing in certain stocks or certain things. So kind of diversify out of the real estate space. So always growing and always building something new, but trying to not have shiny object syndrome. Make sure we're good at one thing or have somebody running that company that's qualified and then move on to the next.
And being able to find these essentially owners slash operators and partners that you've been partnering with, is it just been friends from college and high school that saw what you were doing and said, I'll quit my job too and work with you?
Yeah, pretty much. I mean, everything I own is with my friend from middle school, high school, and college, Lucas. Everything we own 50-50. And then we've brought on people to help us. And, we have about 35 employees right now. And probably 10 of them are buddies from like high school and college and things like that are like, yeah, I'll quit my job and work for you, work with you. And, they've seen what we've done and seen the growth of it and are excited to hop on. And then some other people we've just hired through our network. So yeah, it's been kind of as things come up, I'd rather hire someone I know is a good cultural fit and has my back and will train him a skill than somebody that, has the skills trained, but you don't really know the motivation or the cultural fit. That's always a little bit trickier.
Makes sense. And then I missed this one, so this is going to come out of the blue. What is your usual way of figuring out your strategy to figure out ARV? So I'm guessing you run comps for single family homes. What sort of cap rate do you usually see your banks or your small bank refinance, let's say your apartment complex at, so what your exit strategy is going to be at the end of the BRRRR?
Yeah, so for the houses, we run comps, try to find 3 houses that have sold. So I kind of like to say, to keep it simple, the 3-3-3 rule. So find 3 houses that have sold that's in the same vintage as your house as far as the condition and the size and the location. So you find 3 houses that have sold in the past 3 months within a third of a mile. Obviously, sometimes that's not possible, so you have to go out a half a mile or you have to go out 4 or 5 months. But the goal would be to get as many properties within a closest distance to your house as possible that have sold recently, because that's what the market is. That's what appraisers are going to do. That's what banks are going to do. So that's what you should do. And then the apartments, it's just kind of what the cap rate is for the area, and just trying to buy at as much of a discount as we can from that, knowing that it's going to be a 6 cap rate. So we try to make sure that everything works at that and try to get as much of a discount as we can, along with upside of either getting efficient with rents or or efficient with expenses, or get rents raised up to where they should be.
And then I'm sure at this point you just have a full-time tax guy to handle all of this.
Yeah, so we have a controller. We have like a staff accountant and a controller, and then that's on payroll. And then we have a CPA that's not on payroll, that does CPA work for other people in the real estate space, that kind of buttons everything up and throws the taxes, finishes up the taxes and files them.
What's some advice if, let's say, someone owns nothing and wants to get started? What do you recommend he do? What do you recommend he read?
Yeah, so I would, the easy but real answer, obviously, reading some of the books that are pretty impactful, like Rich Dad Poor Dad's great. Think and Grow Rich is great. So this kind of mindset book. I'm more of like a mindset conceptual book guy, and then an active, knowledge guy from like YouTube and podcasts and things like that are more active, up to date with the current, because my strategy now is different than it was 2 years ago with rates and things like that. So getting your up-to-date knowledge from podcasts like this, like my podcast, Ordinary Guys podcast, and then YouTube channels and things like that, getting your active knowledge from, and then getting a base of knowledge, but then going out and taking action. I think it kind of depends on 2 things. If you need cash now, I'd look into wholesaling and flipping. If you don't need cash now, then I'd get into rentals. So you need to make sure you're in a good cash position before you go all into the rental game. So joining your local meetups, your local Facebook groups, connecting with your local community is the number 1, 2, 3, 4, and 5 things to do once you get started. Connect with your local community wherever you're investing, and you're going to just meet people that you're going to learn from osmosis. They're just going to leak information to you, and then also they're going to intentionally probably teach you and help you out. So you got to connect with the community. You can't do this alone.
Gotcha. And then I know you've mentioned you have an education business. Do you want to talk on like what sort of courses you have, how much they are, what is taught during that, how much hand holding you get, kind of what that looks like?
Yeah, so I would encourage anybody that's listening or watching to just check out my social media at Same Faster Freedom, and on all the platforms to make sure you're comfortable with kind of what I've done and what I'm teaching and how I do it. And then I do have a mentorship. So now it has 2 options. I have like a mentorship with 300 videos of closed Facebook group for questions, 5 weekly coaching calls, all the resources you'll ever need. Basically, the whole mentorship is focused on buying rentals without using any of your own money like I have. So I just basically took what I've done over the past 7 years and packaged it into concise videos and processes and procedures that you can follow. You got to go out and do it, but everything's laid out there for you. That's one option, and then the other option is just a self-guided, just the videos and the resources. So if you want the coaching calls and the Facebook group, that's one option. If you just want the resources and videos, you do it at your own pace, that's obviously a different option. So those are kind of what we're offering right now. I don't have a wholesale course and a flipping, all this stuff. It's all based on growing rentals and building that. We've had about 700 students this year that we've gotten in that. So it's been pretty good and pretty successful, and a lot of people that are crushing it in that space. So that's definitely an option for somebody who's wanting the most efficient and effective path to buying rentals.
Gotcha. So a lot of it is it sounds like a step-by-step video guide, 300 different steps in order to get handheld through it. Do you offer any sort of like not in person, but like over a Discord channel? It sounds like there's a Facebook group, messaging back and forth with you.
Yeah, so the Facebook group, people ask, there's 20, 30 questions on there a day. There's 750 people in it. Myself and my team's in there, so we're answering questions all the time, and other students are answering questions. It's actually become a community. I didn't really think about it like that, but I mean, like in California, there's like 45 students, so they're connecting. And then, Denver, there's 15 students in Denver, and there's 12 in New Jersey, and there's just becoming pockets of people that are connecting through it, which is cool. And then there's those to answer questions. Then there's 5 weekly coaching calls. So there's 5 calls a week that you can hop on one, none, or all 5. They're all recorded. So if you can't watch them or you can't be part of them live and interact, then you can watch the recordings and break down deals there. So it's a group coaching call, but it's one on many, I guess is the way to put it. So we break down deals all the time. You got a couple coaches in the group as well. Someone will want their deal broken down, and we'll break it down over a Zoom call together, but there's just 10 other people in the room listening and interacting and asking questions. So it's better than one-on-one because we have so many instances where you get one-on-one questions answered, but somebody doesn't even know to ask the question you're asking. So they're like, I didn't even think about that. I'm so glad that I was here when you asked that question, kind of thing. So it's taken us about a year to come up with that structure, and it's the most powerful structure that we have come up with so far.
I have one more, and I think you somewhat answered it, of if there's a ballpark way when you look at houses for like renovation costs. I know at the end of the day you do have a contractor go in there and actually give you a quote, but when looking, do you know, hey, this house is $50K? How close are you on estimating at this point of what houses are gonna take, and what do you really ballpark for a lot of these numbers? Do you do price per square foot? Do you do solid numbers for kitchen, HVAC, things like that?
Yeah, so it kind of depends, which is not always the best answer. But yeah, so we have, if something's cosmetic and it just needs like countertops and paint and flooring and nothing digging into much, we can, put $20-25 a square foot. So 1,000 square foot house that just needs cosmetic rehabs is going to be 20-25 grand. And if we're digging into mid-level, tearing down a wall, maybe replacing a roof or an HVAC, and it's a little bit deeper, a mid-level, then we'll do $30-35 a square foot. on that same 1,000 square foot house. And then if it needs complete gut, we'll do, 50, $60 a square foot. So that's an initial quick pass through. But yeah, I mean, once you do it, you get pretty good at, like a standard kitchen rental grade will be 12 grand. Standard bathroom will be 3,500 for complete gut. And, floors are 250 a square foot to replace a hardwood, or $4 for LVP. So you can figure it pretty quickly and get close. HVAC is 4 grand and things like that. You can figure it out, but there's general like guidelines, and then there's I would go generally per square foot, like just the examples I said. Depending on your market, it's going to be different, but to at least know if the deal is worth walking. But once you walk it, then you're going to want to either look at your pictures, somebody else's pictures, and try to get a little more accurate. But at least you can see that it needs cosmetic repairs and put $20 a square foot, and then see if it at least makes sense. And if it, even at that, if it's not even close to a deal, then you at least don't have to waste your time breaking down every single square foot of it.
Yeah, I was wondering if you did the math backwards and, let's say it's not worth it at 100 grand. Do you still throw in an offer going, hey, it would make sense for me to buy it at this number? And you can kind of just drop the offer and walk away?
Yeah, no, yeah. I think it depends on the deal and how far off we are, but we'll usually give an offer because that gives the wholesaler or seller or whoever's bringing you the deal an option to counter. And maybe the wholesaler's trying to make 30 grand on you, which I don't care how much they make as long as I'm buying it at my number. But if we're not close and he's trying to make 30 and he's shopped it to 10 other people and nobody's giving him what he wants, maybe he's going to drop it 20 grand and make 10 and, make your deal work. So just giving them something to work with and explaining why you're lowballing and how you got to your numbers. And, as long as you're being fair with your offer, it usually works out. Or if they're like, I get it, we'll bring you on the next one.
Awesome. And then the last question I have is just, how long have you been creating content for? When did you start and why did you start?
Yeah, so I've been doing it about 2 years, started in 2020. Just kind of was putting stuff out on Facebook locally and getting a lot of friends from high school and college commenting and finding it interesting. So decided to start to post it on, national type things like TikTok, YouTube, Instagram, and just started a podcast recently. And just kind of one of those things, growing a brand and having a, personal brand and a company brand is always important. It's always good, and it's never been easier with social media and phones. So the end game is just have a big real estate education brand, obviously to feed the mentorship and to feed that, but also just to get out as much content and impact as many people as possible. I have people all the time messaging me saying they're taking action and making money and doing deals just from my YouTubes or Instagram stuff. So a lot of people are can take action just through direction on social media, but for those that want more, I have the mentorship for that.